fascinating market, gentlemen.
So to give you your answer
market,
here,
or are we just in an unadulterated bull market that's getting effed with by a president who facilitates a little insider trading on the way?
That's what makes it fascinating, right?
So to answer your question here, data-wise, this was the biggest one-day rally for silver since June the 2nd of this year. For gold, it was the biggest one-day rally since June the 2nd of this year. Same reference point. So not
Wait, is that for like
one,
percentage-wise, you're saying?
Percentage
number-wise?
Yes.
Oh, okay.
Percentage-wise.
Yeah,
obviously.
I guess so. I was really just talking about the number. I mean, $120-something. Like, holy cow.
I mean, that's a lot of points. But looking at just the one-day rate of change, this is the biggest move in, what, 4 months? A little bit more? So,
yeah, I mean,
big moves.
Dylan's right. Look, I usually, people always ask us all the time, are people manipulating the market? What's going on here? I mean, I'm somebody who learned a lot about option flows. We used to look at option flows all the time, 10,000 calls going up in a name, and it's like, okay, something's going on here. It's hard not to overlook what just happened between Friday and today. It's hard not to overlook the fact that, look, I know he sent out a tweet about what's going on with China relations right now, and honestly, that's really not much different than what we haven't seen a tweet like that move the market since basically April, May.
Right.
So it was actually really surprising, I think. And to Tony's point, as we were talking about on last call, the street was scared. They could say they weren't, but you saw the move in the VIX, you saw the huge bar down in the S&P 500, and it really did seem like, to answer your question at the top of the show, it seemed like Friday's move was the move to the next move on the way down. But after the way that we rebounded today, it starts to look like what we've seen a lot this year, where we're just going to continue to go higher once again. That's what it feels like now.
So here's kind of the obvious question that then jumps out at me. I'm usually sort of pulled to the simplest possible explanation. Obviously, we had a dramatic move. There's no question. Obviously, we haven't seen dramatic moves like that, to your point, since April, nor have we had an escalation in the U.S.-China trade war since April. So maybe that actually tracks. When we had the sort of sentiment turn in April, it was contingent on this thing was on pause. And then every time a deadline came up, we got the can kicked down the road. This is the first real escalation in this thing since April. It's interesting, of course, that the president decided to escalate. But I think all of us would sort of concur here that were this headline to come out a few weeks ago versus Friday, we might have expected it to be shrugged off. Because there were similar things that were coming out, and the market had shrugged off sort of adjacent conversations. Now, we hadn't seen escalation with China for a long time, so maybe this is in fact new. But for whatever reason, the markets opted to embrace this. How much of this rebound today is just we have earnings season starting in earnest tomorrow, and nobody really wants to be tilted in a direction to this level before that major event risk? We still don't have any economic data because this shutdown continues. I mean, we have some. We got the University of Michigan consumer confidence numbers, but that ultimately didn't move the needle. There was nothing especially eye-catching in those numbers. Government data is still on pause. This is now the first real batch of meaningful event risk in a while, basically since the shutdown. Is this, and it's not like we came all the way back or even close to it. It was a big bounce, but it was a big sell-off too. So how much of this is just, you know what, we have earnings tomorrow. Who wants to have a strong opinion to the extent that Friday's opinion was strong going into event risk that significant? Is this just people rebalancing their portfolios and going, you know what, I don't want to be overexposed one way or another?
Here's what I think. I think that the market obviously is in these sort of supernova, bubbly, not thinking levels,
Sure.
which makes it both really easy to buy and really easy to own, and probably well advised to buy and own, because it's in this sort of never-ending escalation of fantasy plus supernova plus AI. The liability of that, it's like a balloon with a lot of surface tension, where a specific pointed prick is capable of generating catastrophic losses because of unexpected taxes on China being the obvious thing, but that just happened, or the potential for unexpected 100% taxes on China. But it could also be the potential for unexpected absence of rate cuts, or the potential for unexpected catastrophic news on the abomination of AI and the murder drones, and it's going to be made illegal, and whatever it is, like whatever there's any sort of super negative AI headline, or super negative Trump trade headline, or super negative Fed headline, I'll call it. When you're at these sort of bubbly levels, I mean, that red candle shows you how much potential energy is embedded in the price levels. And so when
Absolutely.
there's a catalyst, it generates all this kinetic energy to the downside, which everybody saw. And then it's kinetic energy compounded by leverage, which also everybody saw. But it doesn't change the fact that the underlying dynamic is a never-ending rising market. And I'll be honest, I mean, I was actually mildly aggravated when I saw the Trump taco headlines, whenever it was, 12 hours ago or whatever, 15 hours ago, because my thinking was, oh, what an amazing opportunity to buy into the Mag 7 here. What an amazing opportunity to buy in even to crypto here, even though I think crypto's a joke. But as a trading asset, at least it's sort of on a sort of reversal. But Trump was such a rapid taco that the opportunity to buy in was actually taken away. Like the obvious, my point is, in the past, I might have looked at the sell-off on Friday as the beginning of like a bigger problem. Whereas now, for better or for worse, because of the Trump taco factor and because of just the historical behavior of the market, I'm actually more inclined to look at a red candle like that one on Friday as a massive opportunity to buy.
So let me ask
nothing to do with anything fundamental. Sorry,
right?
It's entirely on
thinking. Thinking is not
non-thought.
Right. This is a strictly non-thought exercise.
Yes.
So, and I'll pose this question to both of you, because I think we're grasping at something here. If we are in a situation, I think that was a magnificent explanation, where the market had all of this potential energy coiled up at these extreme levels, and then it got a bad headline, and the bad headline turned into kinetic energy with clearly tremendous force. If we are
by the leverage, blah blah blah,
compounded by the leverage, et cetera, et cetera. If we're in a world where the supernova that is the non-thinking AI forever rally, why is that potential energy there? Why are the markets even listening to any of this? And I think that speaks to Jamal's point. Were this a few weeks back, we might have thought, well, headlines, tariffs. We've been over this tariffs thing for months already. We know what this is. We benchmarked this ages ago. We learned in April that when things get quote unquote yippy in the president's parlance, he backs off. We know that we've kicked the can on these China tariffs that are supposed to have this pause on them at least once now. So there's no appetite to escalate, seemingly. We shouldn't have cared, but we cared. So is what we're watching then something else? In my mind, it's probably something else. It's probably not that the markets reacted violently to a trade headline. It's that the markets reacted violently because they wanted to react violently. And what they needed was a trigger. The substance of the trigger itself was probably irrelevant. But we got a trigger that the market wanted because it had all of this potential energy. And
Yeah, I mean,
if that's the case, then
And I would say there's three things that could kick it, which is one, Trump madness. Two, some sort of catastrophic AI insight. It's going to be 5 more years, or AI is going to kill everybody, or whatever it is. Or some sort of like Fed-based, some sort of central bank-based,
Right.
expectations. There's only 3 things that I can perceive outside of another pandemic that are capable of creating candles like the one we saw on Friday. But I guess your point is that the market is super fragile and vulnerable.
Yes.
And given the right catalyst, whether it's Trump-based, Fed-based, or AI-based, will utterly fall apart in the
I would
face.
argue even the wrong catalyst. If the market is ready for a catalyst, it'll find a catalyst. And if the market
But don't you think there's still the trade is in the event of a we'll call this Friday, this bloody Friday situation? The instinct is to buy it.
The instinct is to buy, of course. I mean, my instinct is to sell, but the market's instinct
The market,
is to buy.
my instinct, and the sort of public instinct, if you will, to use a Sosnoffian term, is to buy it.
So Jamal, going into earnings, do we buy it here? Or, and I mean, if we're looking at the futures, we can be buying them overnight going into earnings. If we're looking at ETFs, cash, shares, whatever, we've got to wait until tomorrow. But we already have a big batch of earnings, especially financials, on the menu for tomorrow. We also have a big consumer name tomorrow. We have Johnson & Johnson. So it's a big day. Wells, BlackRock, Citi, Goldman, JP Morgan, J&J. I mean, it's a big day. Do we wait to see sort of what the flavor tastes like? Or is this just an unadulterated buy now? Are we just on discount?
Yeah, I mean, I don't think we even have to guess. It was already answered today. People bought. People came back in. They bought. They saw this as a massive opportunity. And it's a lot easier to buy the market at 6,600 like it was on Friday than it was to buy at 6,700. And so I think that's exactly what happened. I mean, I don't necessarily know if we revisit what happened on Friday. Again, it really did boil down to a tweet. That said, though, I think one of the things that eventually kind of will sow the seeds to what Dylan was saying as far as some of the potential catastrophic things that could hurt the market. When you talk about AI, I think a lot of people keep talking about all these different sort of deals that keep emanating from OpenAI or through OpenAI or whatever. Obviously, AVGO, Broadcom did another one today. And it just seems like they're just pushing money amongst each other somehow or another. I don't really know the real deal there, but I do know every time one of those deals is announced, that stock goes up and it goes up big. And I think the day where you hear another deal with OpenAI and the stock doesn't move big is the day you know the AI trade is over. And again, this started really back with Microsoft about 2 years ago when they were the first ones to sort of create a deal with OpenAI when it might have had a $200 billion valuation, maybe at the time, or 100. It has a $500 billion valuation now. So that thing just continues to climb. And it's a $500 billion company that continues to control the movement of companies that are either the same size or bigger. I mean, again, that was a big move by AVGO today, similar to what we saw with AMD not too long ago, similar to what we've seen with NVIDIA at times. So I think that's something to watch. But in the meantime, look, there's no reason to even really be fundamental about this because there was no fundamental reason why we tanked the way we tanked. You could say that it was the tweet, but that tweet wasn't enough to make the market move 2.5%. I didn't think
it certainly shouldn't have been.
It shouldn't have been. And then even the tweet today, again, we didn't retrace the whole entire move. So I think a lot of people are looking at this like we can still get in while we want, and the AI is only pushing the market higher.
Now, let's say tomorrow we don't get anything bad on the earnings front. Let's say it's give or take as expected, or at least tolerable. No big, oh my God, numbers, no crazy surprises on the downside, no singular catalyst like another tweet, no kind of one headline that you can point to and go, well, if only this were resolved, then everything is fine.
Well, banks know how to make money. I mean, they're going to continue to show us that, I think. I think the only thing that would be scary is if they say something about this environment of interest rates affecting them, which I don't imagine, but I think that would be the only bad thing.
Well, so if that thing doesn't happen, right? If we don't get anything that's a singular headline where we go, well, this is why the market's down. It's this one thing. Let's say we don't get that tomorrow and the market sells off. What does that say?
So repeat the question, Ilya. You're saying that because you're
in my mind,
you say the market is ripe for a sell-off for any. You're saying the catalyst is not the issue; that the market is the issue.
Right. Because in my mind, the catalyst is a flimsy catalyst, and we've shrugged off similar catalysts before. That we have this kind of a response hints to me that the catalyst is secondary, if not tertiary. That the important thing here is that the market reached a level of exhaustion and is done. And that now we are in a trend that is pointing lower, waiting for a trigger, or just waiting to get on the other side of event risk, much like the move from April's lows into these recent highs wasn't about this news or that so much as it was getting on the other side of event risk. As soon as you got to the other side of whatever the market didn't like, it found a bottom and ran because the trend was up. And the market thought that it would continue. That we had the kind of violence we had in response to, frankly, a kind of whatever sort of a trigger on Friday tells me that maybe we have actually turned a corner in a more significant way. And that we are now in a market that...
What about today's rebound halfway back in the day?
That makes sense. Of course. Nothing went more wrong today.
I mean, a gap open
and we have an earnings season coming up as of tomorrow. It kicks off in earnest. So, in my mind, it makes perfect sense that this is the eye of the storm today. Now, could we hang around here for the next week? Do we necessarily need to sell off on Wednesday, let's say? No. No, absolutely not. We could hang out here for days waiting for earnings to wash over us. But if the market perceives something untoward, and I think that something untoward might well be the Powell speech this week, which is the only real piece of event risk of substance out of the U.S. that's on this calendar, if that gives us something that the markets don't like, that'll be enough. And I think that sort of fits within what you were saying, Dylan, the sort of assortment of things that the market doesn't like. It doesn't like a trade war with China. It doesn't like if there is some sort of diluting of Fed rate cut expectations. ostensibly it wouldn't like an economic weakness sort of signal from the data, but we wouldn't know that because we have no data.
I tend to believe that this is kind of over, but you make a good point. When you look at the chart here, I mean, you see the multitude of days where we were down, and they usually came in twos, maybe even threes, right? So there really hasn't been a one-off day, but they're also aside from obviously April, May, right? Since then, which is the period I think is more interesting because we got used to the tweets, we got used to the threats, right? From June, July, August, whatever. And you see these couple of days, most notably probably the end of July, beginning of August there was, I think, the last kind of real scary time, if you will. Yeah, they all had a couple of days together. But I will say, yes, Friday felt like it was just one day. I mean, it felt like it was 4 days in one, really, when you look at it compared to some of these others. So I don't know. Yeah. I think with the coupling, I think if we weren't heading into earnings, I think we could probably see multitude of days down. But I think coming into earnings sort of creates this feeling of, oh, earnings are here. Let's pay attention to that and see what happens.
Yep. No, I think that's
also
exactly
it sort of
right.
verifies the belief that like April took a few weeks to go from Trump's going to do all these tariffs to, oh, Trump's just talking.
Mm-hmm.
Whereas this took a day.
Yeah.
So it went from taking 3 weeks of, threats versus reality to 1 day of threats versus reality. And it really feels to me like this most recent trading event was really to facilitate massive wealth accumulation for the friends and family of Trump. I mean, I feel like the primary motivation for the tweets both ways was to facilitate massive enrichment for those who had the inside information about the tweets.
This is one of those times where it's hard to disagree. I mean, look, he hit the tweet. We dropped big. He sent the tweet this morning. We went up big. Like, it's hard to disagree, dude. I really.
And there's all these new wallets were created. The 100 million here, 100 million there. It just seems so obviously manipulative.
And JP Morgan came out with that this morning saying we're going to invest 10 billion in all these companies literally a day before earnings. Like, come on, man. I mean, which
raises the other interesting.
Most of the time I'm telling people when I see big option trades, it doesn't really mean shit. But if you see that, you just saw what we just saw in the last 24 hours. You see these deals come out. The OpenAI deal comes out. Just so happens that deal comes out today, Monday. Right, it's another thing to keep the market bullish.
Never existed before. Suddenly short 100 million and a half hour before the tweet. Come on.
I mean, this is where
nobody forced anybody to sell. By the way, I mean, nobody forced anybody.
Well, so
to get
exactly. Right. So we look at this and. That's sort of exactly where my mind goes, right? Like nobody forced anybody to sell. We had similar headlines over the course of these 6 months since the lows in April more than one time. They weren't quite so, I suppose, aggressive, where it's like, oh, well, I was going to meet Xi, now I'm not going to meet him. Et cetera, et cetera, et cetera. But nevertheless, I mean, the market has shrugged off similar news and didn't this time. There's no way of knowing. I mean, this sort of goes to the forever Tom Sosnoff aside, which I agree with completely. I could give you the numbers for these earnings over the next week, or some economic number, or the outcome of a policy announcement, whatever. I could give you the information in advance, and you wouldn't know which way the markets are going to go on that, because it's all contextual. It's not about necessarily what the data or the number or the event risk is. It's about where does that outcome line up with expectations, and how does it fit within the speculative mood when it comes out? So nobody could have possibly known that the Truth Social post was going to do what it was going to do. There was no knowing that. In fact, there was all of what we're talking about in our surprise to that level of violence, which is to say, well, okay, he said something mean about she. He says something mean about she every other day. Okay, whatever. Why is this different?
Well, I mean, with all due respect, he did return to the specific threat of 100% tariffs.
Yes, he did. This was
just
more
say
violent
something mean about
than
she.
usual.
I would say it's, anyway, I understand what you're saying, and I don't even entirely disagree with it, which is that the market exposed itself as lacking confidence in its price levels by virtue of the fact that in the face of a little spookorama, it completely flipped its can. And so however confident the price level is and however robust the price action is, it sort of exposed itself for being much more insecure in its pricing than it might represent itself to be based on the trend of the last, couple months. That it's much more vulnerable than it presents itself to be, basically.
Yeah, I mean, in my mind, to quote the great late prodigy, this market looks shook. And that's a significant different thing.
The other thing I don't disagree with you in terms of it exposing its sort of insecurity, but the market is also shameless and has no memory. So,
fair enough.
Fair enough. Like it may have exposed itself as a vulnerable fraud of a market, which might be relevant if it had any shame or self-awareness. But absent any shame of any kind or any self-awareness, what's the difference?
Let's consider, with that as our segue, this situation in the precious metals, which apparently doesn't lend itself to anything whatsoever having to do with any narrative here or there, and just keeps going higher. Obviously, I mean, massive move in gold, massive move in silver. We got a little bit more dovish on policy expectations, and I do mean a little. We got up to 96% likelihood that we're getting the December cut. I mean, October is a given. That's not even a point of conversation. But December went to 96% from 92 on Friday and 85, let's call it. We'll round it up, a week ago. So a little bit more dovish. And the dollar is very quickly recovering from whatever that was. The dollar certainly wasn't uniformly down on Friday. For example, the Aussie got absolutely murdered amid the risk aversion. But the dollar was a little bit weaker against the euro, was a little bit weaker against the yen, the pound on Friday. We're back on offense here for the dollar in short order. And again, the Aussie is diverging. It's mostly following stocks versus other dollar crosses. But for all of this sort of slight extra dovishness, dollar doesn't seem to mind. So the metals don't seem to be doing what they're doing on this basis. I mean, obviously, we had a holiday today or a kind of mixed holiday for bond markets, but the futures were open. And so we can see here, I mean, obviously, whatever that was on Friday held up quite well. Granted, these are the futures, and the bond market had a quasi-holiday today, so maybe we're just not seeing everything yet. But it doesn't look like whatever is going on with Fed policy expectations is the reason that gold is doing this. So Is this a breakout now? I mean, we've taken out the previous high. Should we be buying in here if we're not holding?
I don't think so, man.
Are we just going to keep going?
I don't understand the relationship between the gold and the dollar anymore, and for that reason, I think at some point the gold turns around.
Neither.
Seriously, dude, like it doesn't make any sense anymore.
Me neither. I don't get it.
And we have been around quite a long time, so if we don't understand, I mean, other people don't understand, and sooner or later, people are going to wake up one day and be like, wait, why is this up? Yeah, why is this up? And they're going to, I just think at some point gold sells off, I think. I don't know if it sells off $300.
Short gold, Jamal?
I already am. I'm short gold. Been shorted for about a week. I'm short with an MGC contract. It's probably the cheapest way I can get short gold right now, and so that's why I'm using that. But yeah, and I don't understand the relationship between gold and the dollar right now. It doesn't seem to make sense. And I love a good momentum trade just like anybody else, but I can also recognize when a momentum trade gets extended. And if it's not extended now, then if it extends to 4,200, 4,300, that's extended too, and probably hurts a lot of people on the way, including me. I got to say, if I've been short since 4,000, if it gets to 4,200, I'm going to have to make a decision. $200 higher is not in the game plan. So I can't, I'm not going to get crazy, right? We all know the market can be more irrational more irrational longer than you can be rational or solvent. So I'm not going to get carried away, but I just think at some point this thing turns around. It has to pull back at some point.
I would think so too. I mean, at this point, this is starting to look a little in the parlance of one Dylan Radigan, a little cuckoo bananas. I mean, this is
let's examine
this is very difficult to buy.
This is really cool what happened today, though, to examine and just say, like, wow, when this happened today, we saw SP, obviously the general indexes go up big. We saw these metals move big, and these rare earth metals moved really big. The MPs, the LACs of the world, and that, ladies and gentlemen, is going to be a trade for a little bit. I think that's going to be a trade for a while. I think they're going to ebb and flow. I like to find things like that. It kind of finds, at least I find some comfort. You know, and I remember in 2008 when one day you'd come in and financials were all up, and then the very next day you'd come in, financials would be up and oil names would be down, and then the very next day it would be reverse. And I feel like that's the kind of market that we're heading in right now. Right now, all the AIs are up. I'm not even sure what was down today. I'd love to tell you the counters, but I'm not really sure. Every time I turn around, I feel like most stocks were up. I guess it was the healthcare stuff, I guess, was down today. We've seen those move.
Looking at the sectors, since you mentioned it, a little downtick for healthcare, a little downtick for consumer
staples, right?
Staples.
Other than that, it was like everything. And again, this was mostly everything green, so it's not going to be like this most days. But what you can see is that metals and AI names and AI power names, like that's a whole complex now. It's not just AI names, the AVGOs and NVIDIAs. It's the minerals now with these rare earth minerals, and then it's also the power stuff behind AI, whether it's data centers, whether it's the uranium, whether it's, all of that. That's a whole complex now. And so for you, who's such a bear, for those who are bears, the day where those all get turned around, that's going to be the day where things get ugly. And that's what happened on Friday. That's what I saw.
Yes. Yeah. I mean, I think Friday was an interesting dynamic because what we saw was, gold held up pretty okay. It didn't rally, which was interesting, but it did rally with stocks today, which was even more interesting. And so what Friday kind of felt like, crude oil aside, because crude oil obviously was not near its record high, but also crude oil had a story unto itself with this ceasefire thing in Gaza. But crude oil aside, because crude oil is weird and has been marching to the beat of its own drum for a while now, Friday seemed like sell those things that are near record highs, buy those things that aren't. And the dollar was kind of an interesting fit into that story because it weakened a little, but didn't weaken in any kind of material way that it didn't immediately shrug off. Friday's move in the euro is gone already. There it is. I mean, it's a similar story in the pound. The pound tried to do something, but ultimately ended up going nowhere. Ended up holding at the underside of this range. It broke. I mean, we talked about the Aussie. It had a terrible day. It cared much more about stocks falling and couldn't really get back today. So it seems like gold is almost just froth on, froth off. If stocks and gold are sort of the froth bucket, and let's say bonds and dollar are the not froth bucket, because obviously the dollar is closer to its recent lows, so are bonds, than their recent highs, then maybe that's just where we are here. It's not so much risk on, risk off, as it is what's overextended, where's all the speculative capital, and what's recently unloved. And do we have some kind of a grenade out there? And maybe this is what the market fragility is that we saw on Friday, that it's not so much this or that risk or this or that headline. It's just the market is really skewed to one side in a handful of assets, and capital is getting antsy in those assets.
Yeah, man, look at the Oracles of the world. Look at Microns of the world. These are really big names, man, and they are moving like, I don't know. They're moving like stocks that are half their market cap, and their volatility looks the same way too. I mean, that's why I
71 IV rank on Oracle. That's a lot.
That's why I just said top of the show. It's a fascinating market.
This is why I love Amazon, honestly. How Amazon doesn't have a gap higher waiting at some point in the future. Even better, like if there's one name to buy on this sort of absurdity of the Friday sell-off, it's Amazon.
I actually agree. I think the chart for Amazon here, that it held whatever this thing is down here, going back to late September, that it held this ultimately, whereas the mags more broadly broke down. I mean, here's the mags ETF,
but it also
that's a breakdown.
Had its sort of gap higher super rally,
which didn't make it even back into its former range. And so, from a positioning perspective, this looks like breakdown, retracement, waiting for the next leg down, which Amazon pointedly is not.
Yeah, I think
Amazon actually held.
This is really interesting to me when you look at the charts for these Mag 7s. I mean, they didn't really participate in the way that you would think they would have. Like usually when we would have a rally like this, right? They are the ones that moved really major in that day, and they didn't really do that.
Yes. Which sort of adds to my sense that the market is getting exhausted, at least in those pockets that look frothy. So if there is some kind of thing that ends up being a catalyst, whether, by the way, the market is already loaded up and waiting for that catalyst, or the catalyst surprises them, whether we can sort of take what the reaction was to the president's post at face value, or whether it was just something the markets wanted to do already and just needed something, whatever that is, that the generals, as it were, the big market cap nodes, that they're not really participating here like you see at the index level. That's very curious.
Yeah, it's just a little like they're not at the all. They're definitely all off of all-time highs. They're all kind of seem to be consolidating, which is interesting. I don't know if that's making a move higher or the next move is supposed to be higher or lower. I don't know, but I just find that interesting. And it almost seems as though they always talk about like when gold miners, right? Like people who were actually not gold miners, but those who were actually looking for gold back in the day. The people who really made money were the ones who were selling them the picks and shovels, right? We all know that. And it almost seems like that now. Like people aren't going after these Mag 7s as much anymore as they are the picks and shovels around those names. Like I said, the data centers, all of that type of stuff, the Oklos of the world. It seems like that's where things have been headed more recently. Unless you make a deal and then you get that kind of chart.
Yeah.
But Apple's had that chart, Google's had that chart, Tesla's had that chart. I mean, not to be a broken record, but that's why I'm like, how can you not find a way to be long Amazon in the expectation of some sort of absurdity at an undefined future location? That's no different than the Google gap or the Tesla gap or the Apple gap.
Do you like them more, Dylan, if they lean into AI, or do you like them less if they say something AI related, or they're like, we're going more AI or whatever?
I mean, the truth is I have no idea, but I know that the sort of halo on the entire market is AI supernova. Don't think belong big tech in a way that hasn't been the case in 20 years, where analysis is actually a liability.
Mm-hmm.
Yeah.
And so it's like we're now in a moment where simply existing in the category, which Amazon obviously does, is more than qualifies you for a massive gap higher. And again, Google was sort of left on the sidelines. Oh, Gemini sucks, and they missed the boat. And next thing you know, Google, look at the Google chart.
Yeah.
Boing, it's off, right? Apple missed the boat, blah, blah, blah. But look at that, right?
I mean, it's actually holding up much better than a lot of the other names in the sort of.
I mean, I think Gemini
in the Mag 7 bucket.
Said and done, Gemini wins, honestly, for all the GPT-ism that exists right now. But that's a different thing.
Well, Apple went the different route, though.
By the way, something we need to coin immediately.
Now, Apple went the different route. Apple said, "Lord Trump, we will give you money in the U.S. and that if we do that, is that okay?" And that's what put their stock back up.
Still pulled their gap. They still pulled their gap higher. I mean, they got pounded on Friday, mind you.
Yes,
they still got a couple of gaps. They got that August bump, and then they got their September bump.
That Apple got shellacked like this, by the way, seems to be at least somewhat evidentiary of the market having taken the president at face value, because obviously Apple does a tremendous amount of business in China, and so the story was very relevant for them at a sort of individual company level.
I actually didn't do that exercise. I didn't look at all the names like that, the Apples and the Nikes on Friday. I was not really paying attention to those. I was looking at other stuff, but yeah, those names definitely got hit.
Nike had a bad day.
Yeah. What's the furniture store?
Not IKEA.
Which obviously
is publicly traded.
It's one of them. I don't remember, but I just looked at A&F. A&F got smacked, of course. I mean, they get cheap clothing from that general vicinity, right? I don't know, whatever.
Wayfair got whacked.
Wayfair. Oh, no. What is Kelly Clarkson going to think? Jeez.
Right? I mean, if you want to talk about China supply chains, I mean, Wayfair is a huge one.
Got just what I need.
See,
it says what the commercial says. I don't know if it's real. Yeah,
I've definitely bought some things from there, and they've been, things.
Come on.
They continue to exist and serve their purpose.
Not a glowing endorsement.
I mean, they are not crate and barrel, these things, but they work. They're fine.
Yeah. I don't know, man. I mean, I actually, I don't like that if we're only moving on tweets and whatnot. I don't love that, but I will say I love the market that we find ourselves in. There are so many things that are live wire right now. We talked about most of them today, the AI-related names, the picks and shovels of the AI world with the energy and the power, and then also this rare earth mining thing. And honestly, I repeat, I think when you see all these names moving the way that they are massively and with this volatility included in it, at some point, that is the real kindling on the fire that creates a market downturn more than anything. So I think markets were well within their right to bounce back, because if they fell on the tweet, you're going to rise on the tweet. And so I think there's more of that, unless something changes there, and unless something starts to turn around with all these other areas of the market that are really kind of mooning right now, the AI related, the rare earth related. I think for the time being, market's just here to stay.
What does, before we run out of time here, tomorrow we get a real speech from Powell. Last week he was just giving an intro at the community banking conference and didn't really do anything. This time it's all very official. He's at the National Association for Business Economics. It's the annual meeting. He's giving an economic outlook and a view on monetary policy. This is the real deal. This is Powell for real, for real. This is the only real macro catalyst out of the U.S. that's scheduled, obviously. Now, maybe we'll get a huge wallop of data at the end of the week because this shutdown ends. But until further notice, no. So this is the only real kind of thing that's going to tell us about the U.S. economy this week, other than the earnings themselves. Do we care about this?
I don't think so. All I care about is AI and rare earth minerals right now. That's all I care
There you
about.
go. Thank you, Jamal. Don't care. Sorry.
If my
Do
thesis...
you care?
Yes, I think I do. I care not so much because of what Powell may or may not say. I care what the price action is going to be around it. Because if my suspicion that the market doesn't actually care about the substance of the catalyst, it just needs a catalyst because it already knows where it wants to go. It just needs the trigger to go there, that it's going to find it. And this is a potential catalyst. This is one of those things that the market could take and say, well, I can move on this. This is a thing. And what you're going to hear from Powell, the market is not going to like, almost by definition. Now, of course, that's to some extent expected. And so we'll see, again, if the market decides that it's going to care. Why is the market, by definition, sort of set up to not like what Powell says? Because the Fed told us that they're only going to cut rates one time next year. And if we look at the expectations, they've only become more dovish. So we're looking at 66 basis points for next year now. So there is a meaningful disconnect. The markets think the Fed's wrong. So whatever Powell says, whatever kind of hedgy thing he comes out and says, well, we don't want to blah, blah, blah about over extrapolating that inflation is definitely going to come down. And yes, the risk is that we are going to have some kind of a economic downturn because the labor market, this and this, but we don't know yet. And inflation isn't coming down as fast as we want, blah, 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 blah. We're going to go slow. We're not doing anything fast. Obviously, the market thinks that's wrong. So there is a very easy vector here for the market to not like that. And it doesn't really matter, I would think. If the market is, in fact, in a mindset to not like things, as opposed to like them, which is where we've been for the past, let's call it 6 months. If the market is in a mindset where it doesn't like stuff, it's not going to like it. So it wouldn't matter that we've known this for weeks.
I think one thing that could really possibly make his speech more interesting is if, essentially Trump comes out afterwards and annotates his speech in some way, shape, or form. I think maybe that makes markets care a little more because, kind of like you mentioned, there's really only one cut that's being priced in for the rest of the year at this point, and I don't even know if markets have cared as much outside of the big move of the bonds on Friday, of course, which really was out of fear. I feel like markets haven't cared as much about inflation. Hell, we're not even getting the reports this week,
Yeah, well, this is the whole thing. Like, this disconnect has existed for a while. The Fed has been on the hawkish side of markets for next year's expectation for a good long time now. And every time that the Fed has come out and not endorsed the market's more dovish view, they've gotten a little bit antsy. They stay antsy for maybe 24 hours tops and then go, it's fine. They'll come around and resume the move higher. That, in my mind, is sort of a generalized risk-on market that doesn't want to care about things. But if Friday was the breaking point and we are now in a market that does want to care about things, this is a thing they could care about.
Well, market seems to care about coal and metals all of a sudden again, which is shocking to me.
That's for sure. That's for sure.
And there's only one explanation for that. I mean, it's clearly Trump and the policies and what they're doing in the government.
Yeah.
I just don't see how you don't look. I mean, if anything, I was irritated at the quick reversal because I just think any and all sell-offs are buying opportunities, which a younger version of myself would have never said this. But now that I've accepted the idiocy of the entire situation and the lack of thought that I do recommend, this thing comes down. I mean, look at the copper chart. Face pounded. Face pounded. Buy it.
Both ways. Face pounded both ways.
Buy it.
Bullish, bearish, everybody loses.
Buy it. As sure as I'd sell oil on World War III, you buy anything Mag 7, anything metals on a face pounding. Friday, it was a huge opportunity. The only agitation I had was the idiocy of the reversal so quickly. Like, would have been nice to get a little more time to get involved. At least in April, you had a couple weeks of idiocy. Here you got a few hours. Tough.
And on a Friday. An inconvenient time for idiocy, if ever there was such a thing.
Come on.
And with that motto, buy the face pound. Don't think buy the face pounding.
Pray for the face pounding so you can buy. I was like, face pounding, amazing.
Don't think pray to buy the face pounding. With that rowdy call to action, overtime is out of time. We'll see everybody for this very conversation in a mere 23 hours. But in the meantime, don't go anywhere. I'll be right back with Macro Money, where we're going to look at whatever macro catalysts I was able to scrape together in the absence of economic data for the week ahead. So come back and see what I managed to come up with. We'll be right back.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more. from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
New from Tasty Trade. Unlock 30 days commission-free trading, plus a 1% cash match on all qualifying deposits when you open and fund a new Tasty Trade account. The Money Match event starts now, exclusive to new Tasty Trade customers.
Frequent trips to Vegas, or there was a year I did a couple of them.
What's the most financially irresponsible thing you've ever done in your life? Doesn't necessarily have to be trading specific.
Financially irresponsible, that's a big question. Like people would say like going to college these days, I don't know. Renting, I like renting. I like the flexibility. I don't know. Maybe renting, I guess, by the book is financially irresponsible. Actually, you know what my biggest purchase right when I started my job was $4,000 on a PC setup, which was not a good idea at my salary point.
I mean, anytime you take a trip to Vegas, it's pretty financially irresponsible. I would say that frequent trips to Vegas, or there was a year I did a couple of them, which was pretty irresponsible.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
When you define risk, you set a limit on how much you could lose if the trade goes bad. If you have a small account, you might not be so interested in selling naked options. You'd use up much more buying power, and the risk is undefined. Defining risk, though, controls how much you can lose if the trade goes sour, and it gives you back some of that sweet, sweet buying power. We can define risk by combining options into certain strategies. The short put vertical spread is the simplest one. Selling this put sets your max profit with the credit, and the long put at the lower strike blocks off the risk where you want it. And if you're more neutral than this, you can throw on a vertical call spread to make it an iron condor. The only downside to defining a risk is that it lowers both your max profit and your probability of profit. That little compromise might mean you rest easier, though, and a good night's sleep is priceless. So see, we can define risk when we use more than one option at a time. Pretty simple.
It's the day that went. Pumpkin. Oh, just circles are great.
Well, that was interesting today. We had a massive sell-off in these markets on Friday, and already just one day hence, after the benefit of a little bit of a break for the weekend to catch its breath, the market is back on offense. So, are we really done with whatever that was on Friday, or is this just a brief respite before the selling starts again? That's what we are going to tackle here on Macro Money. I'm Ilias Pivac, head of Global Macro here at Tasty Live. And we're going to start with just to look at how these markets performed last week and in particular look at what they did on Friday, which was, of course, the bloodletting of bloodlettings in recent price action terms. We hadn't seen a sell-off like that in quite some time. And see if we can't figure out what is on the menu here going forward. We have, of course, still this U.S. government shutdown, which makes for a tricky way forward because we don't really have a catalyst or data as context for how we might move forward. But nevertheless, the markets are open, and we are going to move on something. So we do have a week to benchmark. So let's start with a look at the economic data empty way that the week progressed last week. And we can see it was certainly a week of weakness in the risk appetite side of the ledger. S&P 500 down 2.5%, NASDAQ down 2.4%, yields lower for a second consecutive week, down 1.5 on the 10-year, down 1.3% on the 2-year. Crude oil continued to sell off. It tried for a bounce early last week, but that didn't stick. And we end up with a situation where it continues to decline. We likewise get an interesting perspective for gold, which apparently doesn't care about what else is going on in markets. It continues to go up 2.3% this time. The dollar finishes meaningfully stronger, euro down 1.5%, the yen taking the brunt of losses, 2.8% there. That's, of course, compounded not just by the dollar's move, but also by specifics out of Japan. We not only had the elevation of Sanae Takaichi as the new leader of the ruling LDP party. She's very dovish, very much evocative of former Prime Minister Shinzo Abe, her mentor, as far as wanting a more dovish BOJ. And so this BOJ that's been raising rates is not her cup of tea. Not surprisingly, the markets took the yen meaningfully lower on that news. Now, she has lost her coalition partner, the Komeito party, in the course of last week. So it's unclear whether she even has the necessary legislative power for the LDP to become prime minister. If the opposition were to come up with some sort of a joint candidate, she might even lose that vote. But nevertheless, for the time being, she is the de facto next prime minister of Japan, or at least the presumptive next prime minister of Japan, and her dovish inclinations clearly reflected in this underperformance for the yen. Bitcoin likewise down, doing its risk sentiment on steroids thing. So stocks were down, and so not surprisingly, so was Bitcoin, just by a larger quotient. So the really interesting bit here is that most of what these moves amounted to occurred in a single day, and that was Friday. Now, obviously, gold had a little bit of a better showing throughout the week. Also had a pretty meaningful washout on Thursday. But we can see that all of what we end up seeing in the losses for the stock market, especially, there's 2.5 down in the S&P, 2.4 down in the NASDAQ. We can see most of this really gets cemented with these violent sell-offs on Friday. And the sort of makeup of these sell-offs looks very much like some sort of anti-risk liquidation. Bonds go up, yields come down, stocks go down, crude oil goes down, Bitcoin goes down. The dollar is even a little bit weaker when all of this occurs. Now, the presumptive catalyst here, and this, of course, lines up with the price action, was a Truth Social update from U.S. President Trump, who apparently is of a mind to re-engage the hotter part of the U.S.-China trade war, taking umbrage with China instituting export controls on rare earth materials and saying that the U.S. is poised to respond with 100% tariffs on Chinese imports. We hadn't heard that threat in a while. And the markets, which ostensibly thought that the U.S.-China trade war was basically at some sort of a frozen quiet, because the last time that there was a major deadline in these negotiations, the president basically just allowed that deadline to lapse and kicked the can down the road. So it seemed like perhaps what we have here is something where nobody really wants a fight, and we're just talking aggressively until we are done essentially posturing into a deal, that basically this is just a negotiation and that everything will ultimately be okay. This sort of headline suggested that no, in fact, we're back moving toward escalation rather than de-escalation. And the market certainly didn't like it. It is likewise the case, however, that we had a quick sort of walking back of the worst of at least the tone. The president was on social media again at the start of this week saying he's confident that President Xi will sort of come back off the ledge and engage in negotiation. But of course, the comments out of China over the weekend were not conciliatory. They were more on the defiant side of the ledger. And so the president seemingly came out and said, oh, well, I'm sure everything with China will be okay. But China certainly gave no indication that they're taking this latest bit of escalation laying down. So it's unclear how this is going to develop, but it certainly seems as though this is the kind of headline the markets might have shrugged off a few weeks ago and very pointedly didn't this time, which may speak to a broader fragility in the risk appetite camp of assets looking for a catalyst. Now, if that's the case, then ostensibly the market is primed to not like or to find the fault in incoming event risk if it is in fact already minded toward de-risking. If that's the case, we don't really have a very rich assortment of catalysts with which to work with. Taking a look here at the economic calendar, and those timestamps, in case you're wondering why they are in the strange AM hours, they're in GMT or UTC, whichever one you like. Obviously, make the appropriate adjustments for your time zone if this is what you're using, but I use it because there's no daylight savings time on that scale, and that keeps things nice and consistent. But the important thing, rather than the timestamp, is the absence of meaningful event risk. We had a little bit vis-a-vis Chinese import-export numbers overnight. There wasn't really anything controversial there. Things are relatively quiet. We still don't know if we're going to get any U.S. economic data, so ostensibly we're supposed to have PPI numbers and retail sales numbers. We still haven't had a catch-up on NFP. We haven't had catch-up on CPI, which were held back because of the shutdown, and there's no telling that the shutdown is going to end or not end in time for this data to come out. So perhaps the going assumption is that we're not going to get this, which leaves but one thing on the docket here of meaningful substance, and that, of course, is the speech from Fed Chair Powell that we have tomorrow. Now, last week, Powell also spoke, but it wasn't the kind of speech that would elicit a response from financial markets. It was an intro to a community banking conference, so not exactly a policy-oriented sort of endeavor. But this time, we are getting a proper speech with forecasting and forward guidance implications. Chair Powell is going to be speaking at the National Association of Business Economics for their annual meeting in Philadelphia. And this is, to be sure, a economic and monetary policy outlook kind of a thing. And so, in the absence especially of other event risk, this is meaningfully significant because it is really the only macro catalyst that the markets have to go on this week in the sort of purest macro sense. Now, we do have another catalyst here, of course, by way of earnings, which we'll get to momentarily, but from the sort of purely macro world of things, this is really it, unless the shutdown ends and we start to see some economic data. So it is here that things get really interesting because the speech is almost primed to disappoint. Now, that's because in September, once again, what the Fed did was tell us that we are going to have some sort of a, let's say, readjusting of policy expectations for this year versus the forecast that we saw in June, largely because Governor Stephen Miron was added to the board before the September meeting. And when we look at the dot plot, we can see he has been a tremendous dovish outlier. And so what we then end up with is a situation where we've narrowly now adjusted for seeing 3 cuts in the forecast for this year, whereas before we only had 2. Now, it's not outside the realm of possibility that if Governor Miron were not on the board, the dot plot feeding into this would not have given us this outcome, and we'd still be at only 2 rate cuts that the Fed was forecasting. For what it's worth, the market thinks that there's 2 more rate cuts on the menu for this year. In fact, if we look at the expectations for October and December, we can see here's October. The market has been pretty firmly in the camp that this rate cut is happening for quite some time, really. I mean, we've been over 90% likelihood of going back to a week ago and basically hugging the upper 90s, approaching 100% both today and Friday. So no real controversy there. And then for December, we've really locked in very closely now. If a week ago we were just north of 80%, now we're just a hair shy of 100% here too. So the market sees that we are going to get these 2 cuts. The real issue here seems to be not so much this then as it is what's on the menu for next year, because once again, the Fed only has 25 basis points there. And as we've pointed out here before, that is an important disconnect with where the markets themselves are. You can see here the markets have 69 basis points on the menu for next year. And although this is only 39, 40 basis points, this basically comes down to rounding, having to do with the adjustment in these expectations for the actual dates when the meetings occur, in particular in October, where the meeting is at the end of the month. So although this only says 39 basis points were we to adjust this for the dates. And as we just saw with the single meeting probabilities, the likelihood is that come January, we will have had 2 more cuts, one at the end of this month, one on December 10th. The larger issue, again, is this. The Fed is forecasting just 25 basis points, and the market is at 69. So very much erring on the side of 3 cuts, of which 2 are completely priced in. And where the third one rather is at a fairly significant likelihood at this point. So the question then becomes, how is Powell not going to disappoint the markets? If what he is going to do is tell us about how we only need 1 rate cut next year, because what the Fed did in these forecasts is increase growth expectations, lower unemployment rate expectations, and increase inflation expectations, albeit modestly, well, then how are we going to justify the market side of the equation? Now, either Powell would have to come out and tell us that something is terribly wrong with the economy beyond what the Fed said in September and beyond what we've heard from the most recent commentary from Fed officials, where even Stephen Meehan, the most dovish on the board by a long mile, as we saw from the dot plot expectations, even he is saying the economy had a weak spell in the first half of the year from which it is now recovering. Now, he doesn't seem to think that a recovering economy is any barrier to aggressive easing, which is an interesting sort of argument with one's self. But nevertheless, the assessment of the economy is not that it is in a bad state from Fed officials. And Powell certainly seems likely to say something along the same lines, that essentially the labor market has given the Fed reason to recalibrate, not a reason to scramble. And so it looks as though the markets are somewhat out on a ledge here. And if Powell were to give them a reason to be disappointed because they're saying 69 and Powell is going to make the case for something closer to just 25, and the market ostensibly is looking for catalysts, if that's the correct interpretation, well, then this sell-off is perhaps going to find a further trigger tomorrow. Now, macro catalysts aside, slim pickings though there are, the other, of course, critical thing, as we alluded to moments ago, is the earnings calendar, which is aggressive. We are very much in the teeth of the third quarter reporting season this week. Some of the key names here, of course, financials, they're coming in a big batch, but also quite a few important bellwethers for economic activity. Johnson & Johnson due tomorrow. That's obviously an important view on the consumer. CSX coming up on Thursday. That's an important view on demand and the implications of tariffs on goods prices. So it'll be an interesting sort of week. There's plenty on the calendar. We'll see how these things ultimately shake out. An interesting sort of analysis here from FactSet. Now, of course, we don't have the bulk of these releases. Obviously, we're just going into the third quarter reporting season's sort of most dense bit, but we have had some reports already coming out. And what's interesting here is, as we've seen in recent quarters, there seems to be another kind of sense that the markets are reluctant to reward companies that beat expectations and quick to punish those that disappoint. So we can see that in instances of positive surprises, the historical norm is for the price response to be on average a 0.9% gain. For this reporting period, we're looking at a third of that at 0.3. Whereas on the negative side of things, whereas the 5-year average has downside surprises punished to the tune of 2.6%, here it looks like they're getting punished to the tune of 3.1. So this is not an encouraging perspective on risk sentiment. It suggests that the market is more responsive to bad news than good news, and perhaps that helps to illustrate how a day like Friday happens. That it's not so much the substance of what the president said, as it is that the markets were looking for a downside catalyst and found it. And if that's the case, if this sort of speaks to a larger sentiment evolution, well, then Powell has the potential to move markets, and so do these earnings reports in a asymmetrically negative way. Much as they had the capacity to move the markets in an asymmetrically positive way from the lows in April through these recent highs that we've just reached in September, around the idea that the news was more like event risk to get through than substance, with the markets quickly shrugging off any weakness and finding support. If in fact we have seen the sentiment switch flip over, we should be seeing that dynamic now in reverse. Whereas before, the markets, even on negative news, would have modest responses that then quickly gave way to dip buying. If the pendulum has truly swung and Friday was day one, then what we're looking at now perhaps is the market really selling off on bad news and shrugging off positive news with maybe a day's worth of a shuffle on the upside. And so with that in mind, just updating my exposure here, I'm still very long the US dollars. In fact, I've added more. I'm now more short the Aussie, more short the pound. You can see I was selling just one contract last week. I've doubled there. Added into the euro as well. I still have this long-term holding in the Brazilian stocks ETF. This is not anything that I'm making contingent on current dynamics. I'm holding, as we can see, with expiries at the end of the year, and we'll just see what happens there. I have reestablished some small bearish exposure. Last week it was in the S&P, and just today I added a little bit of NASDAQ on the bounce, and still very long the bonds. In fact, I added a little bit today. The bonds seem to be offering a nice opportunity, having pulled back a little bit from Friday's highs, and still short crude oil, which seems to be working with Friday's sell-off, and I'm going to stick with that for now. And that is Macro Money for today. As ever, we are here Monday through Thursday right after overtime, a show I usually co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Likewise, writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Tasty Trade's Money Match event. Unlock 30 days commission-free trading. plus a 1% cash match on all qualifying deposits to jumpstart your trading when you open and fund a new Tasty Trade account. Level up your trading experience with Active Trader Mode, smart order tracking, risk analysis tools, dynamic watch lists, and more. The Money Match event starts now, exclusive to new Tasty Trade customers.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
If you've ever been curious about where to start with crypto, join me, Ryan Grace, for the Tasty Crypto Show. Alongside co-hosts and industry guests, we'll break down what's going on in the market and show you how to take advantage of crypto. No hype, no shills, just crypto know-how. Watch us live, join the chat, and fill your bag each week on the Tasty Crypto Show.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
All right, we're back. It's the Tasty Crypto Show. I'm Ryan Grace, and with me today, of course, we've got Shelly Van and Dan in the house, in the cave. Dan, welcome back, my friend.
It's good to be back. I'm really excited to be here. I missed a lot last week, it seems, so I want to break that down and, figure out what the move is, because I was convinced it was October, but last Friday it didn't seem like it was. But I don't know, we've rebounded a little bit, so I just want to break that down.
That's what we were told, Shelly. October.
Was it a lie?
I don't know. That's the question today. Is it over? We're going to jump into that in just a second. But before we do, get over to the Tasty Live YouTube channel, pop out the chat, type some crazy shit in the chat, or maybe more so, type congratulations to Dan because this young man just got married.
Look at that ring.
That jewelry's looking nice on you.
It's gold, so
shining.
Price gold's up.
Nice.
Okay, yeah. Yeah, if you have to sell it, you can get a better price today.
I hope we. Fingers crossed.
That might be worth something
Yeah.
soon. Congratulations to Dan on his marriage. All right. Now that that's out of the way, is October over? Oh, there you go. Sound effects.
Is it?
I don't know. What do you guys think? We got the performance dashboard. We're going to take a look at the bounce in markets. I think by now everybody has probably read the 1,000 headlines around the mass liquidations, biggest ever in the crypto markets. Of course it's volatile. We forgot for a moment. We forgot for a second that you could get a tariff tweet at any time, or like I don't know if it's a true social message that turns into a tweet. I don't know where it all originates. But I'm not on Truth Social, so maybe I'm not really getting the alpha, if that's where it starts. But Trump moving markets, of course, on Friday. And then I think at the worst time ever, after the close, and you get some of those kind of liquidation levels into the weekend, things are a little bit thinner than they would be otherwise from a liquidity perspective. We got that second tweet, that second shoe that drops, and all hell broke loose for a moment. So you were getting married, I think, at the time.
I was driving home.
You were driving. Markets were crashing in some cases 50+%, depending on what you were tracking. Before we get into it, did anybody step in and buy the dip? This goes out to the chat as well. Any big trades? It took some guts to step in there, but you saw some prices too, where if you're long-term bullish in this, it's like, wow, that looks to be a little extreme. What'd you guys do? Any activity on your end?
Well, I told everybody last week that my dad is now a Tasty trader, and he had funded his account, and it was just sitting there. He was waiting for me to get him into crypto. So I went bulldozing into his front door, and I said, it's time. And so, yeah, we bought the dip pretty big.
Beautiful. What were you buying?
A little bit of Bitcoin, a lot of Uniswap,
Okay.
which has proven to be an incredible.
I saw Uniswap go to like $2. I don't know, maybe for a second.
I think it wicked.
Where'd you get it at?
568, I think.
Nice trade. Okay.
Yeah, so he's up quite a bit. Got him a little bit of XRP, I think some Solana.
Okay,
But
yeah,
he's,
Solana traded into like the low 180s. I was able to buy it there, fortunately. I sold out of some of it on this move.
Yeah.
Doge went to like 15, 16 cents.
Did prices stay there, or was it pretty? It was just a wick down, wasn't it?
Pretty swift.
I was coming back from, I think, getting a haircut like in the afternoon, texting with my brother, a couple other guys here at Tasty Trade, and it just basically it's like, okay, the liquidations are coming, because these guys aren't really familiar with how some of this stuff trades or what happens at times, and oh my God, were the liquidations coming. I haven't seen anything like that in a very long time, maybe ever. But Dan, it was like, all day, obviously there was some weakness, but you saw ETH go from like 4,000, let's say, at the time to 3,500.
Yeah.
Just like that.
Yeah.
And then instantly right back up. You're trying to get your bid in at 35, 35.50, chasing, like just trying to hit the mid. And it was moving, of course. But, that was maybe the least of it when you look around at some of the other tokens. Like Shelly said, got Uniswap at $5. It's trading at $7 right now. So some nice moves, nice bounce back. I mean, in hindsight, we're a little bit more joyous, but anything could happen. But yeah, I mean, looking backwards, it's been a pretty good trade.
Mm-hmm.
Yeah, I'm looking at October 9th, 2025 total liquidations in the futures markets. We're looking at $16.7 billion worth of long liquidations were wiped out. Interestingly, Hyperliquid, which we've covered a little bit, 9.3 billion in liquidations, Bybit 4.3 billion, Binance 1.4 billion in liquidations. So yeah, it got hit pretty hard, but I don't know, despite that, we're still at 115,000. So it's kind of, I don't know, quick rebound. These things usually get these cascading liquidations, people step in and buy. So
you tend to see these V bottoms when you have these flash crashes. And I think that's the best way to describe this. This was a flash crash, function of market structure, less really selling related to some sort of event risk, and certainly not tariffs, right? At least as it pertains to crypto specifically, in terms of the asset class and volatility you might experience. Obviously there's that headline risk, but I mean, come on. I tweeted about this, and I don't know. I'm surprised. I'll put it this way. I'm surprised the market still goes down as much on some of these. And maybe it was that everybody, when crypto was levered up, we had a relatively low volatility kind of period for some time. At all-time highs, you get that pullback and things like the NASDAQ and elsewhere. But I'm just surprised that we still fall for this stuff.
So I didn't really track. I mean, I was kind of logged off, so I guess I saw it kind of go down a little bit, and then didn't see it until it rebounded. So I was like, okay, it must have been a flash crash. But if I look at the BVIV, which is the Bitcoin Volmex, Bitcoin Implied Volatility Index, it shot up to like 50%, and it had been trading at like 30% for a while. So I do think, back in, October 6th, it was trading at 39. October 9th, it spiked to 57. So we did get that volatility spike, and I feel like that was coming for a while. If we looked at the April lows, which was the April low was like the tariff unwind or tariff trade, and then wasn't there like a Japanese yen unwind or some carry trade unwound?
Yes, yeah, over a year ago, but Liberation Day, in April.
Was that it? Liberation Day,
flashcards and the
tariffs
on everything,
and then we have been just in up only since then, until Friday. So. Yeah, I mean, it's worth it to have some limit orders in at some point, I think.
All-time highs on Monday, and 102 spot price in Bitcoin by Friday. Gotta love these markets. Guys, I want to jump into the slides now. We've got a couple of performance dashboards, maybe try to put some things in context and then look at some other trades and maybe some ideas here in the market. But we started this off a couple of weeks ago talking about the seasonal performance that tends to show up in crypto and in asset prices, asset markets, generally speaking, tends to be a decent time. We looked at returns and we discussed the seasonality in the fourth quarter, and specifically October, where for whatever reason, historically Bitcoin's gone up, hence Uptober. But you get these moves in the past week and it kind of makes you rethink everything. So let's talk about whether or not this is over. I'm curious to get your thoughts and where you guys are. But before we do that, let's take a look at the performance dashboard. So very quickly, a couple things to call out here. We track price momentum across daily, weekly, and monthly timeframes using exponential moving averages. 3 different moving averages. When they cross over, they give us a signal. Pretty straightforward approach, but it keeps us on the right side of the trend. Bitcoin has gone from bullish to neutral. If you recall a week ago, last Monday when we did Options Trading Concepts Live, it was green everywhere that you could see. We've shifted a little bit. Bitcoin is neutral, and you've got a bearish and I apologize, this should be bearish for Doge as well. But you have bearish signals, at least short term, across everything else. Maybe no surprise given some of the volatility that we've experienced. That said, what I will point to is in terms of the trend, 3-month in there, still positive performance, right? That can change. That's on a rolling basis. But when we just look at today, what's the trend look like? How do we measure this in a 3-month period? Still positive territory. And then year to date versus Bitcoin, ETH's up 4% on a relative basis, XRP and Bitcoin Cash. And then here's that explosion in volatility as well. Just a week ago, these were much, much lower. And you can see that when we look at those IV ranks too. Bitcoin's implied volatility rank, to your point, Dan, is at a 3-month high and trending higher here off the lows. ETH a little bit higher.
I mean, I feel like in these markets, there's always sort of this volatility. So I don't know. I don't think it's over, but I think things are getting a little out of whack in some ways. Meme coins got killed. Altcoins got killed. So
although Punk Strategy didn't really. I mean, it's hanging in there.
Yeah, because I feel like that has a bid. That has like an infinite bid.
Yeah. So I wouldn't say all of them.
Some of these like narrative-driven sentiment coins, like
right.
Sure. Zcash is another one. I know we don't offer this, but it randomly shot up.
Yeah, I've seen that Zcash has been up quite a bit. Monero too has been another outperformer. Some of these privacy coins.
Yeah, privacy coin. This was like a narrative I was hearing about months ago, and it finally kind of popped off. I mean, I wouldn't be holding Monero at all, but Zcash might not have been a bad trade. BitTensor went up too.
Yeah, that one has worked well. What was interesting about this, and Shelly and I did beans in your absence, and we noted at the time that, this is 9 o'clock, 10 o'clock Central Time. BitTensor, symbol is Tau, T-A-O, for anybody that's following along. It was up about 12%. Pushing into the 400 level prior to the tweets and the carnage in the markets. And then it flash crashed to 200. So I was able to buy, fortunately, a bit underneath 300, and it's nice to see that bounce back up towards 4 now. I still think that it's one that, over time, trades a lot higher, in my opinion. But yeah, that's another one that's had a nice rebound. And I think, that probably, to some extent, speaks to, again, just the short-termism of this move and the deleveraging that really occurred here. I don't think this is related to some outlook on the global economy or the impact of tariffs or a trade war between the U.S. and China. Certainly that's going to introduce some volatility and you're going to see some risk-off moves. But I don't think that's at all what you're seeing impact crypto here. And I think that's, again, evidenced by just how hard some of these have bounced back and in some cases are trading at higher prices than they were pre-tweet, I guess.
Yeah, I don't know. I just think crypto's a smaller market. Things get overheated. You can get 100x leverage pretty quickly. These things happen. And even with this crash, what do we touch? What do we touch? 105, 100 on Bitcoin?
Yeah, it traded down into about 102 for a quick second. Yeah. But you pretty much got right back to 110, which was within that one standard deviation move we were looking at.
Now, I did see that Binance had some issues with their order book, or
I think everybody did
yeah.
when this sort of volatility showed up, unfortunately.
Yeah. Which happens.
Happens in the TradFi markets too.
Right. But the thing that becomes an issue, I think that Athena depegged, which Athena for a while I think has been looped, leveraged, deposited in DeFi, whatever. So I do think the stablecoin Athena USDE depegged a little bit. Where it becomes an issue, or where you could see some sustained down move though, is you continue to get these liquidations down, right? It rebounded pretty quickly by what the end. I don't know. I forgot what time on Friday. It was after the market closed, after traditional markets closed.
Yeah, into Sunday. Once eventually you got the other tweets that were inevitably coming, in my opinion, where it's we're Xi Jinping is a great guy. We're smoothing things over. Stuff, you know. Hopefully we can come to an agreement. They got JD Vance on TV. Right. I mean, by Sunday, you could tell in the crypto markets, they were kind of front running where the open was going to be, and then a huge update today in the market.
Right. Now, what's interesting too, I don't know if you saw this, but there's this account, Look On Chain. It's a Twitter account, and then there's some other Nansen, some of these like on-chain data analytics companies. They noted that a big seller came into Hyperliquid and some of these dexes, and they brought like, I don't know, some crazy amount of Bitcoin, like a couple $1 billion worth of Bitcoin, and they started shorting Thursday or like Wednesday or Thursday
account
before, from like a new account, and so there was speculation that it was somebody in the know, you know, that some tweet was coming. So it's just sometimes these markets.
I think since then the account holder has been doxxed, and it is seemingly tied to a crypto CEO, a CEO of an X firm, maybe has a lot more than that. Decent timing, but I don't know if there's anything there. But I would argue that somebody always knows something.
Yeah. So
it's true of all markets.
Right. Right.
But interesting to see the timing of that trade. Great trade, right?
I mean, I feel like that always happens, and then in hindsight, it's like, oh, you know, somebody must have known something, and it's like, yeah, maybe, or there's probably
hate the player, hate the game. I guess.
Exactly.
Yeah.
Well, looking at the game, guys, really quickly, weekly expected moves here. Given the increase in volatility, you're looking at about a $7,000 move in Bitcoin, a little bit over $400 in ETH, and almost a $30 move in Sol. It's a decent move in Sol from where we were. You know, if you recall, we were looking at $15 to $17 moves. Now, well over 10% of the underlying price. Same thing, about a 10% move when you look at the ETH move on a 1 standard deviation versus the price of ETH. Not quite the same when we look at Bitcoin, but almost a $7,000 move, a larger move than what we've seen, but still well within the range that we've been trading. And the way that this sold off, it certainly wasn't orderly at the time, but took us to levels that if we were going back over the last couple of weeks, pricing in where vol and spot prices were, and it's a very simple approach, but it helps with just giving you some framework. I don't think it's perfect by any means, but you're just calculating 1 standard deviation range based on those variables. And we're trading, I would say the behavior of the market is well within what we might expect, right? In terms of this trading activity or the price action that we're seeing, you know, taking us down to 108. Now, are you going to go 116, 105? Sure. But, you know, still pricing 122,000 on the upside. New all-time high would be just north of, I think, 126. So we'll see how this trades throughout the rest of the week. But again, not some extreme move lower where you didn't bounce and there's this huge rise in volatility. Volatility has picked up. But again, implied vol here of 39% off of those highs that you mentioned, Dan, but realized vol of 42%. This is still low by many historical measures, even though we had a huge move, at least when we look at Bitcoin. The others are, sure, 100, you know, we're like at 120% vol in SUI, which gets you a 50-cent move on a, you know, a $3 underlying now. That was another one. That went to 50 cents, Dan.
Really? Did you get any?
No, I was just looking to buy some ETH at 3,500 at the time. You know, it was just moving so quickly, and you can only buy so much or trade so much at once. And yeah, in hindsight, you know, these were all flashes, though. Flash down, and once those levels were liquidated.
Do we even think people got, like, that's what I mean? Like, you don't even know.
Tough to say.
Yeah.
Yeah, I mean, at that point, right, so you flash down to 50 cents in SUI, buyers show up in size. I don't think that there's, you know, a consistent offer at 50 cents, 55 cents. It probably reset really quickly.
Right.
You know, I think we basically traded back up to kind of 250 and kind of trended or traded higher from there.
Yeah.
So looking around elsewhere, just a quick check of Bitcoin market cap dominance. Same thing you saw here. I mean, as everything just got absolutely smoked for a second, BTC-D went up back into the 60% range, has pulled back a little bit here. ETH, Bitcoin, on a trend basis, ETH is still outperforming. Solana is still outperforming Bitcoin over the last few months. We saw that with the year-to-date, relative performance too. I will note that Solana is underperforming ETH as of recently. Given the volatility in here, those things can change in an instant. But, kind of when I look at this, the takeaway for me is if I'm going to buy one or the other right now until that changes, I'm probably going to be a little bit more overweight ETH versus Sol, at least at the moment. I still think, though, Bitcoin leads the recovery here.
Mm-hmm.
What do you guys think about that? Because Tony asked me on the show earlier today, you look out through October, and I think one question was, are we higher at the end of October? So I want to get your answer there. But then, do you see Bitcoin lead here, or do these others bounce back first?
Go ahead.
I'm hitting you with the hard questions.
Yeah, I mean, I feel like when we get these risk-off moves, people kind of de-risk and then buy back into Bitcoin, and Bitcoin usually kind of is the one that people sort of flock to or de-risk into. And then, as we get some clarity, like ETH, Sol, some of these other ones get bid up. I don't know. I don't have like a good sense of the market right now. I feel like we're just in a range bound. ETH 4,500 between 4,000 4,500. Yeah, I don't know. Solana. I think Solana continues to underperform though. I did see an interesting stat that Solana's reached an all-time high with stablecoin flows. So I don't know. Maybe there's something there. I don't know.
Shelly, it's October 13th. By the end of the month, are we higher in Bitcoin? Yes or no?
I'll make it easy. I'm just going to say yes.
Yes.
Yeah.
And do you think Bitcoin leads, or we see a recovery more quickly in some of these other tokens?
I think Bitcoin leads,
Okay.
but not by very much.
Okay. Shelly seems to be a little bit more bullish than Dan, but everybody here leaning on Bitcoin.
Yeah.
Versus alts at this stage. I tend to agree. I think we're higher. I think that we're in a environment. I mean, when I look around, right, Bitcoin's just an asset class within a much bigger kind of global macro market. And you look at the rebound here today in equities. I mean, the Nasdaq, the Russell. Look at the move in some of these industrials. Look at the move in some of the stuff that's tied to, and for obvious reasons here, given the back and forth on trade, but you look at the move in some of these names tied to rare earth elements, uranium, nuclear power. You're not seeing it so much in things like crude oil or natural gas necessarily, but I think there's just a lot of signs that you're in an environment where you're going to see asset price inflation, and I think relatively speaking, you're going to see an inflection higher in economic growth and to some extent inflation. It's made it tougher with the government being shut down and not getting the data on a regularly scheduled basis as we would otherwise. But I think, my view hasn't changed at all from where we were at the beginning of the month when we were discussing October and what might be behind it and some of the driving forces there. I think. You're still in that same environment. There's no change as of right now. It could change, but I think it's one in which you want to be long. And I think that this is an environment where historically, crypto has done well. You might get some chop in the meantime and you kind of rethink things. But it just seems like that's the way that it would play out, right? Of course, it's going to just blow everybody up to just then go on to new all-time highs. And it's going to be very frustrating. And that to me would be kind of the pain trade is higher here. After the vol that we just went through. But I do think we're still at that stage in the cycle where you kind of are seeing it play out where it's ETH almost in competition on a relative basis from a performance perspective versus Bitcoin. They're kind of going back and forth, who's going to take the lead. I do think that Bitcoin has to top before you really see that rush into alts and that recovery and ultimately some of the crazier things that could happen. I think that Bitcoin has to top first. At least that's what we've seen historically. And I don't think that it has. I I don't think, in my opinion, that 126 is your high in there. That doesn't mean that you shouldn't take some money off of the table when you get to those, the top end of those ranges. The weekly one standard deviation moves in the same way that you might want to wait and patiently buy back if you get near those lows. So I think you still want to trade around these things. But if I just look at the trend in there and kind of where we are in the cycle, I still think you got a little bit of room to run. It's just my opinion. One last slide I want to show, though, guys, just to kind of put some things into to perspective here. We've talked about October, Q4, seasonal outperformance at times. You look at the last 10 months, and it's very clear that October and the fourth quarter have been good times to be in the market. But if we zoom in the last 5 years, you get a little bit of a different picture. It's a little bit more mixed, though Q4 and Q1 still have been pretty decent. In fairness, though, I wanted to look at some of the larger drawdowns that we've experienced in the fourth quarter alone over that last 5-year period. So if we're super bullish, October, blah, 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 what could we expect in terms of downside volatility? Like, at least what have we seen historically to put things in perspective? And as you can tell here, quite often, just about every year, right, you get during that fourth quarter period, and sometimes multiple times intra-month, you can see double-digit drawdowns. And if we go to November of 2022, that was your FTX collapse period, and obviously that spilled over into subsequent months. But down 30% in Nov 2022, down 32% in December 21. You go back to the COVID kind of periods there, and clearly, you have some volatility as well. But I just think, again, it's important to remember that as bullish as we might be at times, patience, sometimes it pays off, and you can get those double-digit drawdowns, and we just had one, if only for a moment.
Look alive, everybody.
Is it over?
Nah.
Not yet.
Okay. Not yet. All right, guys, we will leave it at that. Thank you for joining us, and thank you guys for joining me here on the show. We will be back on Wednesday, same time, same place, Tasty Crypto Show, and then back again on Friday with Beans. But until then, if you have a question, you have a comment, you want to hit us up, send us an email, support@tastycrypto.com. Follow us on Twitter @tastycrypto. And maybe most importantly, subscribe to the Tasty Crypto YouTube channel. And also sign up for the newsletter, too. Just do it all, please. We'll be back on Wednesday. Until then, I'm Ryan.
I'm Shelly.
I'm Dan.
Peace.